Hello, this is Dr. Adam J. Bach. In this short audio presentation, we're going to finish up our conversation about venture capital. We've already talked a little bit about angels and VCs, and now we're going to walk through a capitalization example. So this is often referred to as the venture capital model. It's a mechanism that helps understand how ventures raise multiple rounds of financing. There's usually some assumption about there being an expected exit value, and given what that looks like, we can clearly assess based on the investment amounts what the likely deal prices are going to be for a given round. I want to be very clear about this. Although these kinds of models are developed carefully by venture capitalists, they're often very complex quantitative spreadsheet models based on extensive assumptions and calculations. It's important to recognize that ultimately each of these deals is negotiated on a one-off basis. Every deal is different. Every round of every deal is different. And so it's less important that you have some, in-depth understanding of the calculations. In particular, it's unlikely that you have really deep familiarity with discounted cash flows or weighted average cost of capital or internal rates of return. But you should understand that this is a fairly sophisticated process that is negotiated and ultimately usually negotiated based on these models. But once those models are determined, then the actual numbers and actual deal terms are negotiated as part of a qualitative process that's driven heavily by people. So all of this begins with the reality that for a given venture capital portfolio, there's a specific model that's required to make this work. So when a venture capital firm invests in 10 companies, there's a basic assumption that probably around half of those companies are going to fail almost completely. That is, all of the money will be spent and there will be no returns at all. The venture capital firm will get nothing back on those investments, or very, very little back on those investments. And that's just a reality of the fact that these kinds of companies have a lot of uncertainty and risk associated with them. The technology may not work out the way they expected, the market might not develop the way they expected, or there could be completely other factors that simply no one could predict. But many of these startups, these tech startups in particular, and high growth startups are likely to fail. And some of these companies won't completely fail, but they just won't generate any returns either. So for example, in this model, we have 5 companies failing completely. 2 of these companies, they're not successful, but at least the venture capital firm or the other investors get their money back. So $100 is invested and they get about $100 back. A couple of firms do reasonably well. So in here they're shown as 4x returns. That is, the investors put in $100, they get $400 back. And then some of these companies are, in this case scenario, only 1 out of the 10 is hugely successful and generates 15x. And so this then shows a annualized return of about 20%. So the idea here is that over 5 years, the venture capital firm is trying to generate 20% or higher returns per year. And this shows you what the profile of different company return expectations is. What this means, though, is that if you are a startup company and there's no way that your opportunity has the potential to generate 15 times returns, then there's no point in the venture capital firm even considering you as an investment because you don't fit this model. And even if you say, well, I'm certain we'll make 4x, that's not interesting to them because there's no way to guarantee that, and they have to treat all these companies the same. And so this is often very disappointing and frustrating for entrepreneurs because they really do think there's a good opportunity, and there might be, but it doesn't fit the overall venture capital model. So we're going to quickly walk through an illustration of what a capitalization might actually look like through 4 rounds, the founder round plus 3 rounds of external funding. So initially, there's a founder round, and it is normal for founders to put money into their companies, even if it's not very much. And in this case, we're talking about $10,000, $0.01 million. And so the founders put that much in, they get 100% ownership, and now they are ready to go out and raise money from perhaps angels. And presumably they accomplish something at the very beginning. They put together a business plan, they get a patent, they identify potential strategic partners, or they create a prototype or something like that, so that they can go to angel investors and say, this company is worth something now, and we want you to invest. So here's what that might look like. Maybe the investment is $500,000, $500,000, and we see in this case a pre-money valuation of $1 million. We're going to talk a little bit about pre-money valuation in just a moment, but the basic idea is that when they go to the seed investors, they're saying this company is worth $1 million. And we would like $500,000 to keep moving the company forward and hopefully hit a specific milestone. Well, the way we look at ownership here is the ownership of the new investors is their investment divided by the post-money valuation. Well, post-money valuation equals pre-money plus the investment. If you think about it, it's pretty straightforward. The company was worth $1 million, and then the investors put $500,000 in. Well, that means that the post-money valuation is $1 million plus $500,000, which is $1.5 million. And since the seed investors put $500,000 in, they own 1/3. So the founders still own 2/3. But what's interesting is now you can look and see how the founders' value has gone up. Initially, they put in $10,000, which is all the company was worth. Now they own 2/3 of company worth $1.5 million, which means their stake is theoretically worth $1 million. Now they can't do anything with that. This is an illiquid asset. But this is really important because many entrepreneurs get caught up in this issue of, oh, my ownership stake went down. And it did. It went from 100% to 66.7%. But the value of their stake went up. And that's the thing that matters, right? So yes, control is important and needs to be considered. But ultimately, what you're really trying to do is try to create value. So then let's do an A round. And the A round is going to be much bigger. It's a $5 million round. But let's imagine that the terms are roughly the same. We now argue that the company is worth $10 million before the investment, or I'm sorry, the company is worth $5 million before the investment is made. But it's a $10 million A round. I misspoke. My apologies. A $10 million investment. Well, we can look through the same process. The post-money valuation is $15 million. And here, whereas in the seed round, the founders retained 2/3. Here, the new investors are getting 2/3. That's pretty unusual. You will almost never see deals happen like that. Most investors don't want to take a majority ownership in any given round of funding. But for the sake of argument, we've put this in here. Again, we can now see how the percentages change. The founders' ownership drops by 2/3 from 66% down to 22%. But the value of their stake has gone up yet again, so from $1 million up to $3.3 million. So again, they've now lost control of the company. The investors as a group now own majority control of the company, but the founders' value has still gone up. Let's imagine now that this company is hugely successful and never has to do another round of funding and then is able to go to an initial public offering. That's pretty unlikely, but for the sake of argument, let's pretend that that's what happens. And now the pre-money valuation is all the way up to $100 million. The amount that's brought in through the IPO is $50 million. That gives us a post-money valuation of $150 million. And the founder's ownership stake drops again by 1/3 because that's what the investment was 1/3 of the value. And so again, we can look at the founder's ownership, which is now up to $22 million. And you get that by simply multiplying their ownership stake, 14.8%, by the valuation, $150 million. And so again, it's really important to notice here that at this point in time, the founders only own 15% of the company. And you might think, well, that's disastrous. They started with 100%, now they only own 15%. Well, sure, but at the beginning, they owned 100% of something that was worth $10,000. And now they own 15% of something that's worth $150 million, which means their piece of it is worth $22 million. And that can be sold. Now that it's a public company, they can sell that stock on the public market and capture some of that value. And this is this crucial element about dilution. There's a difference between ownership dilution and value dilution, right? So the percentage stake may go down, but the value of your ownership stake goes up. That's the ultimate goal in these capitalization processes. And so you can see that whereas the A-round investors only made 7 times their money, the founders made more than 2,000 times their money. So this is a pretty important step to recognize in terms of how these things play out. It's the earlier you get in, the higher a return you expect to get, and presumably the higher risk that you take. So the key question that then comes up is, well, where did we get those pre-money valuations anyway? How do we value an early stage company? And the answer is that very often you can't. Early stage valuation is very much an art. There's a number of things that you can do to try to get a handle on it. You can think forward to a likely exit value. Usually that's based on comparables, similar kinds of companies that have exited in the past. You can look at how much you need from your investor and what their expected return is. That will give you an indicator of what your likely valuation is. You can try to figure out based on what your ownership requirement is and how much money you need, but you have to be very careful about that. Because that may be based on what your expectations are and not what the market will bear. So again, the 2 key calculations, post-money valuation, that is how much the company is worth after the money goes in, is simply equal to the pre-money valuation plus the investment itself. Another useful calculation is that post-money valuation is equal to the investment that's put in divided by the ownership stake, the percent that the investors are going to get. And you're usually going to triangulate with other methods. So you might, if you're more sophisticated, use a discounted cash flow analysis of future projections of the company. You might compare that with benchmarks from other deals that have been done, and then also compare that with what you're expecting as far as long-term exit and investor return expectations. So this is, although there's a huge science behind this, ultimately this also gets negotiated and depends on a lot of different factors. There's an example provided here for you. I know that this may, for those of you who are not math enthusiasts, this may look quite frightening. It also may be completely unfamiliar to those of you who don't have any experience with internal rates of return or discounted cash flows. I'm going to explain it just in a moment, but you are not expected to know this for a quiz or a test, for example. So let's imagine for a moment that our pro forma projections, that is our financial projections going forward, suggest that we're hoping to exit in year 5, and we think that when we do exit in year 5, the company will be worth about $10 million, and we might have gotten that because there's $5 million in revenue, and in this industry, historically, exits happen at about a value of 2 times the revenue. So again, here we are triangulating based on industry data. Let's assume that we're taking a $100,000 investment at the start of during year 0. So this is before this 5-year time frame begins. And let's say we believe our investors want a 60% rate of return. We can then use that to calculate how much they need to get back in 5 years, which is 100,000 times 1.6, which is our return rate to the 5th power, and that gives us just over $1 million. So that then tells us what ownership stake that they're going to need in order to achieve that. If they need to get back just over $1 million in 5 years, and we think the company is going to be worth $10 million, then they need to have 10.5% ownership. Because at $10 million valuation, they'll get just about $1.05 million for their investment, for their ownership piece. And so then that would give us a pre-money valuation. We can look at what the post-money valuation would be, which is we know that they're investing $100,000 and the ownership piece they need to get is 10.5%. So we can calculate the post-money valuation from that. Which comes out to be about $950,000. And since they're investing $100,000, that means the pre-money has to be that post-money minus $100,000, which is about $850,000. So this is a way of backing out a valuation based on what our investors would expect. Again, if you're not familiar with this, we don't expect you to be able to do this on the quiz or a test. It's a really useful thing to be aware of, but it is just a little bit more sophisticated than would normally be relevant in this kind of course. So hopefully this gives you some sense of what capitalization might look like. For an example, it's just an example. All of these numbers will vary dramatically based on the type of investor, the stage of the company, the sector you're in, the growth opportunity, and so on.